Hi, and welcome to the CostofCarry podcast. My name is James Chi, and thank you for tuning in today. Let's get started. Something that's been on my mind lately has been this notion of sustainable lending, and whether or not lenders should price or be more inclined to do financing on assets or deals that display a more environmentally friendly benefit to society, whether or not that comes in pricing or whether or not that comes in terms of availability of lending. The reason why I think this is going to be an interesting topic in the next 5 years is because the notion that in your traditional sense of getting a car loan, which are predominantly petrol based or fuel based, the emergence of electric vehicles or EVs are becoming much more common in the streets. I know, for example, Tesla has been the main figurehead of this industry. However, in the last 24 months or so, a lot of other car brands are starting to come out with their own types of EVs, whether that be Mercedes-Benz, BMW, Porsche. Toyota came out with the Prius very early on as a hybrid model car, and that has been hugely popular. Other manufacturers such as Hyundai, Kia, and Mitsubishi have also come out with similar models. And I think this will be interesting because where the industry is going to develop is that we're starting to see a lot of third, fourth, fifth generation models of these cars, and what this is going to lead to is a situation where there is a second-hand market for them. So, for example, Tesla came out with most of their models around 2015 in what was new to market. However, 5 years later in 2020, some of these cars they've already been owned. Dealer financing was only available on new types of cars, and we're finding that with the upgrades in the technology in these vehicles that people would prefer to have a longer battery life or would prefer to have a more reliable vehicle, because I know there were some bugs that needed to get worked on. However, now that we're into the period of fixing these bugs and releasing new models of these vehicles, for example, Tesla now has the Cybertruck coming out soon. It will be interesting to see how lenders decide to finance the second-hand versions of these EVs. Similarly, if we want to extend this argument into the residential mortgage space or commercial space, how will lenders look at properties that come back through the valuation report and display a level of sustainability, whether that be through water tanks, insulation, solar panels, grey water tanks, recycled materials, things that aren't your traditional type of building projects, ones that incorporate a lot more sustainable practices. And so it will be interesting to see whether or not those types of securities get any preferential pricing or lenders want to take more of these deals on. And I think this will be an interesting space, and only time will tell how it will play out. But considering that the finance industry and institutional finance markets have been trying to balance this new notion of green bonds and sustainable investing, as well as whether or not we should be financing mining projects or exploration of more non-renewable resources. And although retail type of lending isn't as extensive or as risky perhaps as those types of deals where billions of dollars can be at stake at any one point, I feel as though that if there is a general consensus that these types of deals are for the greater good, then I would be surprised if they don't get accepted into the lending model for these institutions. On another point, something that is of high interest at the moment, as is sustainability, is the impact that coronavirus is having on SME activity. And while the government has released a large amount of stimulus to help maintain people in jobs and help keep businesses open, it will be interesting to see whether or not businesses can both access these stimulus packages as well as how they will use these stimulus packages to either generate more assets or maintain their costs or develop their business so that once this lockdown period is over, that it will be able to return to regular activity. And one of the more prominent features that the Australian lending space has done is that it's offered its customers a 6-month repayment holiday on their loans. So, for example, if you have a standard residential mortgage, most lenders, given certain tests that the borrower fulfills, will provide a period of up to 6 months, and this usually comes as 3 months right now, and then once those 3 months are up, then it's reassessed, and then that's where the decision to go another 3 months comes from. But it will be interesting to see whether or not in this deferral period, if people can actually return to their regular repayments. And that isn't to say that the repayment's going to be the same, because the interest is capitalized into the loan. The full amount of the loan is still owing. None of the debt has been wiped off, as far as I'm aware. But what will be interesting, and why I think some people have been a little bit too quick to respond with such a drastic action, is that the government nor the health authorities know exactly how long this coronavirus lockdown is going to last for. And while there has been talks about easing it, it's still evident businesses are still shut, the lockdown is still in effect, cases of coronavirus are still emerging, and so it's somewhat dangerous to start taking on money when you can, rather than being patient. And the reason why I say that is because the Australian government has also released a package whereby it will guarantee SME unsecured loans up to $250,000. So up to a total of $250,000. That can be from one or multiple institutions. Again, up to a total of $250,000. And I think this will be interesting because unsecured lending isn't cheap, and while there is a 6-month repayment holiday on that as well, what will businesses be doing with this money while they are in lockdown? For most businesses, this will mean covering expenses. And whilst that's good to keep the lights on, that isn't, in my opinion, the best way to sustain the business, because what really drives the business will be cash flow. And so if those borrowers of that $250,000 aren't also preparing themselves to generate further income by either adapting their business model or looking to adapt their services or their products sold, or how they conduct their business, or how they manage their staff, then the $250,000 is just delaying the inevitable in that respect. And although we don't want to see any businesses collapse in this period, we have to be mindful that the lenders also have a responsibility to mitigate their losses as well. So whilst some SMEs may come to the bank in the hope of getting this money to keep their business alive, if that applicant can't demonstrate their plan or how they forecast their coronavirus activity to be, this is going to be a massive problem for those types of borrowers. I think now, in this period of lenders being cautious about new-to-bank clients, it is important to make sure that you understand what you're getting involved in, because the lenders will be conducting very, very, very strict assessment guidelines, and that will entail both your current and past financial performance, but also looking into your future financial performance as well. And that's also just to give a little bit of guarantee on their part to make sure they're doing a responsible lend. This notion of best interests and responsible lending will be very relevant to this era, because not only do brokers and lenders want to ensure that they can keep funding and keep lending out money or assisting finance, but they also want to make sure that society isn't just taking the availability of money or the cheapness of money for granted. It is something that it does affect the whole economy, and if certain tranches of borrowers start defaulting on their loans, that does pose a bit of a problem. That's where the broker or the best interest duty fits in, because the role of the broker is really there to provide credit guidance and assistance, and to provide the insight and knowledge and comparison of options available in the market that most applicants aren't aware of. And so best interest doesn't always come down to price. It does come down to what is suitable for the client's needs. And that's something that the lender may not always provide, simply because they are only able to offer their own products and services, whereas the broker's role is to intermediate the whole process and engagement, so that they can research their entire panel and see what's available that suits the clients to their best needs. And sometimes going direct to the bank is exactly what the client needs or wants, but in most cases there are a lot of advantages and benefits to shopping around and being patient for the best deal. So it isn't as though the broker will be eliminated by a coronavirus lockdown, but the role of the broker will be enhanced. The broker will need to enhance their role so that they are up to date with what types of solutions are available to suit their clients, as well as how fast they can deliver that. And that's what's really important, I think, to most borrowers in this environment, is the opportunity cost, or the cost of delay, is what kills a lot of deals. And so people need to be aware that while it may be contradictory to provide a more expensive product to a client, it is somewhat more advantageous to provide something that can get done and does provide a similar service, just at a higher price. And the higher price would factor in the speed as well as the assessment that the loan undergoes. So I think that will be an interesting development in the industry in the next 8 to 10 months. Hopefully this period of coronavirus ends and that things can start getting back to normal, but in all honesty, it's going to be difficult. It's going to be hard to imagine that anything will go back to normal after this. There's just too much at stake, and I think that with money being so cheap and people having fixed rate loans, there's just a lot to watch out for. And whether or not that extends past 2 or 3 years after coronavirus, that will just be a matter of how quickly a vaccine can be found, as well as what consumer behavior emerges after this period, and whether everyone just wants to go shopping or wants to start borrowing money. On another point, when it comes to the role of the neobank as well as a specialist lender, when it comes to these types of periods or situations where while there's a lot of money, there's also not a lot of money that's being given. So in Australia, with the 4 major banks, there's a lot to be aware of when it comes to approaching them for a loan. And the reason for that is the assessments of these loans at these major banks is often a lot more critical than what one may think is necessary. And that's because these majors want to ensure that their books are squeaky clean. And whilst that's good for them, and that's why they can offer such cheap rates, because they know exactly what they're looking for some borrowers, this model doesn't accept them for their profiles. What this has led to has been the emergence of the neobank and the specialist lender that fill these lending gaps and provide this new modern experience that caters towards these particular near prime or alt doc or specialist type clients that may have at one point been a major client, but due to changes in regulation they now no longer fit within their box. And so that's part of what the neobank offers, is this new experience of, alright, they have a mold of what they're looking for, but they're willing to also consider special or extenuating circumstances or specialized situations that may require a different assessment. So for example, ATO debts have been something that have traditionally been something that has been shunned away, simply because usually if there's tax debts, there's also something else that's wrong. However, through an analysis of the information that's provided in the submission, brokers are able to, I suppose, storytell and explain why this borrower is seeking finance for an ATO or for a tax debt, and how paying off this tax debt will allow them to still maintain their business activity. And if we can look back through their financials, that everything has been clear except for this one period where this tax debt has emerged. Similarly, bad credit, for anyone who's missed a phone bill or a utilities bill, that being on your credit score, or have missed a credit card repayment at one time, that can affect your ability to get a loan, simply because it relates to your credit behavior. And whilst it may have been something minor, or it may have been for a genuine reason, such as you are moving houses or something, the appearance of this event on your credit report does impact your ability to seek finance, because as I mentioned before, major lenders like borrowers who fit a certain profile, and sometimes bad credit scores don't fit that profile, and this is where the neobank and the specialist lender fits in. And whilst this may be inconvenient, unfortunately this is pretty much the only option for some of these borrowers. It isn't something to be ashamed of or should be ignored as a solution. It is something that some people understand, who still have good cash flow and good income, and only have a slight hiccup on their file, do understand, and this can make the difference between a deal going through or getting the finance that you need to realize asset growth and wealth creation, or between missing out and kicking yourself a couple of months down the track wishing you had done the deal. And for a broker to have a neobank or a specialist lender on their panel with an accreditation is definitely an advantage, especially because unless you know the exact types of clients that you want to write loans for, most of those neo and specialist lenders are going to be able to cater towards prime and near prime clients. However, they are not going to be as competitive as major borrowers. So I think it's always good to have that option available just in case. That doesn't mean it has to be your go-to lender. However, it allows you to have that solution for your client, or that potential client, if they ever come to you with a circumstance that requires it. And on that note, that concludes this episode of the Cost of Carry podcast. Thank you for tuning in, and I look forward to speaking to you next week.